To get to the floor show, joining me now live is Charles Schwab, Managing Director and Chief Investment Strategist, Liz Ann Sonders. Liz Ann, it's great to see you.
Nice to see you too, Cheryl. Thank you.
Thank you for being here. And I was going through your mid-year outlook, and one of the things you talk about is what I just mentioned in my introduction to you. You say between tariffs, immigration, labor market dynamics, fiscal pressures, that the U.S. economy and the stock market have significant challenges going into the second half of the year.
Oh, no question about it. I think, the word uncertain has been thrown around arguably a bit too much. I think it's kind of a generic term. And I always chuckle at the old phrase of the market hates uncertainty, because I often think, well, is it ever certain? I think it's unstable, maybe the best descriptor when it comes to policy. And I think business leaders are expressing this and just saying that they need to know the lay of the land, the rules of the game, have some certainty, and then they can navigate through this. I think, yes, we have seen benign inflation readings recently. We have not seen more than just cracks forming in the labor market, but I think it's premature to say nothing to see here. There's been no impact. I think we still have the risks ahead that we see the dent in economic growth specific to the labor market and some upside to inflation. We're just kind of in the middle ground right now.
Well, and talking about those tariffs and the issue of stagflation and about the different, estimates as far as what the big beautiful bill is going to do or not do, this kind of plays into the fiscal spending situation that you mentioned in your notes, and that we are basically looking at an effective tariff rate on the nation right now of is more than 15%. That's the highest tariff rate we've seen as a country since the Great Depression. And you're flagging that pretty early on in your research.
Yeah, well, so if the reciprocal tariffs that were announced on April 2nd had not been delayed by the 90 days, you were talking about an effective tariff rate somewhere in the mid to high 20% range. Now, to put that in context of where we were before this year's trade war began, beginning of January, the average effective tariff rate was less than 3%. So even if things do settle down at around where they are now, we're talking about 5x the level of tariffs, and we haven't tested the U.S. or global economy yet with those levels of tariffs, save for the period in the Depression. But we also know that tariff rate is a moving target. And what's interesting is specific to the budget bill that's working its way through Congress. Just about any reputable organization that estimates the trajectory of the deficit says it gets worse over the 10-year budget window. It was the case that the CBO came in and said, but if you take into consideration tariff revenues, that is an offset. But they used what the tariff rate was up to and on May 13th, and then extrapolated that over the 10-year window. I'm not sure I have confidence in a 10-minute window in terms of the tariff rate, let alone a 10-year window. So I think it's way premature to start to calculate tariff revenues in as an offset to whatever we get ultimately with this bill and the impact that has on the deficit.
Well, and CEOs and business owners across this country, Liz Ann, agree with you that they need certainty. And when you have tariffs that are changing by the day and stories changing by the day, today it's auto tariffs, tomorrow it could be, pencil tariffs. I mean, it's left and right? But, one of the things you talk about in your note kind of reminded me of what we heard from Jamie Dimon at that Morgan Stanley conference. And he talked about the uncertainty with the U.S. economy. He was on Fox Business back in April. He really moved markets by saying that he thought that it was likely we'd have a recession. And I know that bet has kind of pulled back. But you also talk about how when you have a level of CEO confidence where it is right now, that also portends potentially a downward trajectory for the U.S. economy, maybe even a recession.
Yeah, so if you do track historically CEO confidence, one of the connection points as a high correlation is capital spending. That said, in this environment, I think you have to look at capital spending as falling in two buckets. There's AI-related spend, and the trajectory there is likely to stay healthy and strong. And then there's everything other than that. And that's where I think the uncertainty factor is going to plague that CapEx. I don't get a sense that it's really going to fall off a cliff, but companies that have essentially put themselves in a timeout as it relates to long-term forward-looking investment plans, CapEx included, I think for now they stay in a timeout, because to your point, what business leaders are saying is we can navigate pretty much any set of circumstances from a profit margins perspective, from an earnings outlook perspective, but not knowing the specifics means the default switch is set to do nothing at this point. And frankly, that's what the Fed has done too. They put themselves in a timeout. For now, anyway, that seems to be the right call until we have a little more clarity.
Even though you've got President Trump calling for them to cut right now, which is not expected. Liz Ann Sonders, it's great to see you as always. Thank you.
Thank you.